Hi, I'm Andrew, and I'm going to be talking about Savannah Federal Credit Union throughout the Great Recession of 2007 to 2009, specifically years 2008 2009. We're going to go over the overview of the credit union, then the economic environments of the time, because without that it's not really worth mentioning what's going on if you don't know what's going on in the economy overall. Major findings of the analysis, so just how they were doing and handling the recession: profitability, employee productivity, asset quality, capital adequacy, asset liability management, and then we're going to go back and do a summary of it. So this credit union is located in Savannah, as the name would imply. The assets are around 18 million, and the employees, they have around 6 full-time employees. And their history, they opened up in 1931, so I mean that's during the Great Depression. They've been around for that and now this current recession. And they originally opened for the Army Corps of Engineers, but since then they've expanded to other federal employees in Chatham County. They've moved to employees of formerly Armstrong University, now merged into Georgia Southern. They, in fact, in the past year have merged with Bullitt County Corps Credit Union. So they've expanded a lot in a short amount, like in the past decade or so. And when you look at what they're offering credit cards, vehicle loans, so that's for automotives, boats, and RVs. They have mortgages and then medical expense loans. And then the economic environment of the time for 2008-2009. Firstly, a lot of major financial institutions fail. So you have Freddie and Fannie who fail. You have lots of large banks failing all over the place. And so it really is a time of panic in the financial environment of the United States and really the rest of the world. The interest rates, they actually plummet to some of the lowest we've seen since the recession in the early 80s. So at that point, whenever the interest rates are going that far down, these institutions are really panicking as to what's going to happen to them. Because when the interest rates fall, their profitability is going to fall. Unemployment rates, they have soared to 10%, which is extremely high. We haven't seen unemployment rates that high since almost back to the Great Depression. Now it's at like 3% to 4%, and so our unemployment rate has really went down a lot since then. And then the housing values, they fell drastically. I mean, that's why it's called the housing crash. You know, housing values fell 30%, and since that is one of the major assets that many people use for loan, and they get loans for housing and all, their values falling are really affecting all these financial institutions. Foreclosures hit record high, and then the credit union loan delinquencies, they increased, and so a lot of these credit unions are not going to be able to pull in the same profitability they had in the past. The major findings, so for 2008 and 2009 both, Savannah Federal appeared originally to have a fairly good profitability as shown by ROA, that's return on assets. However, whenever you look deeper into it, it's really kind of an inflated number. They have really bad loan quality, and they have a lot of loans. Over half of their assets are loans. So by having such a poor loan quality and such low provisions for these loans, their profitability really is a lot worse than it would appear at first. And so then they do show an above average profitability, like I said. However, with their low provisions for loans, especially when you look at their loan quality, the return on assets is really inflated. And so whenever you look at the numbers here, it shows Savannah Federal having around 0.33% as opposed to peer average of 0.30. However, that puts them as being better than 88% of their peers, which seems really good, but once again, with their low provision for loans, once you take that into account, their profitability is really closer to around 0%. Then in 2009, they did improve a lot. While most of the peers in the group fell down to loss, Savannah Federal did improve, and they had almost 3 times as much. They had slightly over twice as much increase on return on assets. And once again, they were inflated with low provisions for loans. But this time, once it's taken into account, they still are highly more profitable than the rest of their peers. but the number is not quite the whole story here because of their bad loan quality and low provisions. Whenever you look at the employee productivity, in 2008 and 2009, they did have slightly below average performance with their employees and productivity. And so part of that is they're overpaying some of their employees, and they also have a lot of employees. So when you look at the rest of the credit unions, they're having around 450 members per employee for both 2008 and 2009, as opposed to Savannah Federal, who has around 300 members. And so that's around 150 members difference that they're having an employee just to deal with that many less people. And what that's doing is it's really bringing up their costs and their overall expenses that they really don't need to be able to compete with their peers. And they're pulling around worse than 80% of their peers, which is really, really poor quality on their members per employee. When you look at their average loan balance, this is one of the things that Savannah Federal really is the best at. It's one of the things that brings their overall productivity up. So they're writing out loans for around $3,000 to $4,000 above the rest of the peers. And so what that's doing is whenever they write out a loan, they're being able to pull in around 50% more profit as opposed to their peers. And in both years, they were really able to outperform on quality or the amount per loan than 85% of their peers. So they're being able to pull in more profits with less having to write out loans. And then whenever you look at the salary for their employees, you can really see that they are overpaying their employees a lot. So in 2008, they're paying their employees $4,000 on average more than the rest of their peers, which means that they're paying more than 70% of their peers. And then going into 2009, while the rest of the peers went up slightly, Savannah Federal really increased their salaries per employee, although they didn't increase employees overall, so they did increase their salary per employee. And so now they're paying around $13,000 more per employee, and that means they're paying more than around 85% of their peers, which is really driving up their expenses overall, which is hurting their profitability. When you look at their asset quality, Savannah Federal has poor asset quality, and like I said earlier, they have around 55% of their assets are loans, and their loans are in really poor shape. So whenever we look at their delinquent loans to total loans, we're seeing that they have around 2% of their loans are delinquent, as opposed to peers are around 1.5%. And then going into 2009, they're at 2.5% of their loans are delinquent, whereas the peers increase a little bit, but nowhere near the amount. And so in both years, Savannah Federal ends up having delinquent loans more than around 3/4 of their peers, which is really putting them in bad asset quality. And then when you look at the charge-offs, that's what's really concerning about this credit union, is that in 2008, they are writing off 0.17% of their loans. So we're seeing how many bad loans they have. We go back here, they're worse off than 75% of their peers here, but they're writing off less than 25% of their peers, while their peers are writing off around 0.66%. And so what that means is they're just keeping bad loans consistently. They're not writing it off like they should. Now going into 2009, they did improve a lot. So they went up to writing around 0.45% off of their loans. However, the peers are still writing off a lot more loans, and they have worse loans than their peers, and so that's really concerning with their profitability. And so in 2009, they were writing off less than 60% of their peers, while they have a worse asset quality than around 75%. Whenever you go to the capital adequacy, in both years, Savannah Federal is in really good standing as far as capital adequacy is concerned. They have a very high amount of equity, and so whenever we look at their net worth to total assets, we see that Savannah Federal has around 23% of their overall assets are net worth, and so what that means is that 23% of their assets are owned by the shareholders, and that really protects the depositors with all their bad loans. You know, they can afford to have some of the loans go delinquent without having to worry the depositors. And whenever you look at peers, they have around 15 to 14% They have a higher capital than 91% of their peers in 2008. Going into 2009, their overall net worth to total assets does decrease slightly. However, it doesn't decrease near as much as the peers, and so they are still better off than 88% of their peers. And this is really good because of their poor asset quality. They need this high cushion to protect the depositors from bad loans. Whenever you look at the delinquent loans to net worth, this is around average for both years. In 2008, they're having around 5% of their net worth is delinquent loans. Going in 2009, it increases around 6.33%. But as far as compared to the peers, they do stay around average. So they are slightly above average in their delinquent loans, but they can handle it because they do have such a large net worth. Whenever you look at the asset liability management, they do have very poor asset management. They are keeping a lot of cash on hand, and they're not writing off loans like they should be. So whenever you look at the long-term assets, Savannah Federal has around 17% of their total assets are long-term, and the peers are around 18 to 19%. Going into 2009, Savannah Federal does go down to 16%, whereas the peers stay around 18%. However, they are right at the average, so it's not too concerning for their long-term assets. However, when we look at their short-term assets, this is really where we get concerned as their management. They have 32% in 2008 of their assets are cash and short-term, as opposed to the peers are around 25%. And so they're just stocking short-term assets and cash more than 75% of their peers here. And going into 2009, they do improve a lot. They go down to around 26 to 27%, while the peers stay right at that number, 26 to 27%. And so they do improve a lot going in 2009. They're no longer sitting on cash. They're they're loaning out more. They're able to make more profitability on better returning assets. But in 2008, that really did hurt their profitability, just sitting on low return assets. And whenever you look at their core deposits to their total shares, Savannah Federal has really poor standing as far as their source of money. So in 2008, they had around 40% of their total shares were core deposits. And what core deposits are is it's kind of the cheap money that credit unions can get. That's the money that they're going to pay the least cost of funds on. And so that's what they really want to have a lot of. But they have less than 75% of their peers have better standing with their core deposits in 2008. Going into 2009, they do increase their core deposits by around 6%, which is really good for them. However, the peers stay around the same, but they are still far behind their peers. They're still having core deposits less than 65% of their peers, so they are paying more for their money that they are lending out. Whenever we go to their total loans versus out of their total assets, Savannah Federal has around 55% of loans as part of their assets, while the peers have around 58% in 2008. And so that's right at average. It is a little bit below, but what this means is that Savannah Federal is not hoarding up too much of their money. They are loaning out a decent amount. Going in 2009, their standing with their loans to assets is still pretty good. They do go down. They have less loans going in 2009 in preparation for what they believe will be prevailing interest rates. However, the peer average also goes down, so they still stay better than around 40% of their peers. When we go to the summary overall, the main story here is that Savannah Federal, they have really bad loan quality, and their loans make up over half of their asset quality. So what this means is that they really have poor asset quality, which is further made bad for them based on the way that they're managing it. So management's not writing off loans like they should be. They're not charging out when they are going delinquent. So they're holding assets on their books that are really essentially worthless. And so it's making the profitability appear good while it's really kind of poor. So their asset quality, like I said, is really bad for both years. They have an extremely high amount of delinquent loans. And then their employee productivity is around average. So that brings them around average for 2008, 2009 for that, but it's not enough to make up for their bad asset quality.